Hello everyone, this is Ron Itzkovich from Skills of the Trade. In this video, I'd like to show you how you or anyone could have easily seen basically back in 2008 when the 2008 US market crash would most likely happen, as well as when it would most likely end. Now this is done easily through technical analysis, basically, of the S&P 500 index. Now, the S&P 500 index is a conglomeration of 500 of the largest companies in the United States. And when you take the average value of their stocks and put it together into an average, you get an index. Now this index is basically a representation of the US economy. Whenever those companies are doing well, the US economy, of course, will also do well, and when they don't, you can see it as well. So here in this chart we have the S&P 500 index, and we can see that it starts here at 1995. This chart starts in 1995 and goes all the way to today, 2017. The economy or the price of the index went up into this way, down, and up again. Here we see the beginning of the 2000 dot-com crash. As you can see, it's around this value, ending in around 2002. And again here, this is the crash of 2008, ending around 2009. Now, by taking a horizontal line and placing it on top of this peak, of the price peak over here, and stretching it horizontally, we can determine with a very high probability that the price will most likely reverse when it reaches a previous top, such as this one that we had in the past. And this is what it did actually. The price did reverse and went down when it reached the same price level as it has in the past. Similarly, we can take another line and draw it horizontally from this low that we had at the end of the 2000 crash, stretch it horizontally, and we can see that likewise the price did reverse when it reached a previous low. Now we can use another indicator to determine the probability of a reversal at such locations as these, what is called support and resistance points, by going down to the weekly chart of the S&P 500 and adding an indicator which is the MACD indicator. Now here we see the MACD indicator down below, and basically the MACD indicator is a tool that can be used to place on top of a chart. It's basically a charting tool, and we can use, for example, the line over here, which would indicate to us that the bulls are stepping out of, if the line is sloping downwards, such as in this area, the bulls are stepping out and the sellers are coming in. That means we have a slowdown of an upward momentum and more of an increase in the downward momentum. Oppositely wise, we can see that when the line goes up, that means we have more, the bulls are dominating, the buyers are dominating, and the sellers are getting off. So if we actually retrace the price as it was going back up in around towards the end of 2007, it touched the top of the previous high that we had, this line, went down and went back up again, while at the same time the MACD reached a lower low as the price came to this location. Basically, the price went slightly higher in this second time around, while at the MACD made a lower low. This is called a divergence, basically. And when we see a divergence, when the price comes back up to a previous high and makes a higher high, while the MACD makes a lower low, that's called a divergence, and it's a very strong signal of a price reversal. So we can see that at around the beginning of September 2007, this MACD divergence has occurred, and it's a very strong signal for a price reversal as well, further indicating that the price will continue downwards. In the end, towards the end of the 2008 crash, we can see even clearly here that the price made a lower low, quite the opposite of what happened over here, made a lower low than this point. Now, while the MACD did actually a higher low. As you can see, here's the one peak and another peak. It made a higher low. This is also a divergence towards the upper side, meaning that a very strong signal that the price will now reverse at this area and continue straight up. So this is a very easy way to determine for investors of the US market, or just in general, when the prices will most likely reverse and at which locations they will most likely reverse. So as we can see, it was very clear from just by looking at a simple S&P index chart when the price will most likely reverse using these tools that we just learned. Now today, the price is over here, 2017, and we didn't really have a major reversal as of yet, such as those ones. Now I'm guessing that this reverse will most likely happen as it has in the past, around a cycle of about 8 to 10 years apart. And we already had about 9 years since the last major crash or major reversal. So we'll probably be expecting to see a major reversal downwards probably in 2017, this year or next year, 2018. And we can expect that the price will go down and reverse perhaps at similar resistance points or support points such as this high or this low, or most likely this area where the price will come down and then reverse back up. Thank you guys for watching. I hope you guys learned something new from this. This is Ron Itzkovich from Skills of the Trade.